Welcome to Talk Tickers, your essential shortcut to cutting through the noise of earnings season and extracting those truly critical insights. Today, we're diving deep into the Q2 2025 earnings call for the ODP Corporation, ticker ODP. This isn't just about the numbers, it's about understanding the why behind the headlines, what management is really trying to achieve,
Right.
and most importantly, what it means for you. We've got quite a fascinating story unfolding here about a company trying to reinvent itself.
Absolutely. Our mission today is to distill their strategic moves, their, financial discipline, and how they're navigating what's clearly a very shifting market landscape. I want to give you that clear, concise picture, highlighting the nuggets of information that truly differentiate ODP's narrative. And let's be frank, the market reaction to this call was notably strong,
It really was.
suggesting investors are seeing something compelling in their story, perhaps a transformation in progress.
All right, let's get right into the nuts and bolts then, with the top line numbers for Q2 2025. ODP reported GAAP EPS, that's generally accepted accounting principles, earnings per share of $0, zero.
Yeah.
But here's where it gets interesting. Their adjusted EPS, which often strips out one-time charges like restructuring costs to give a clearer picture of ongoing operational performance,
The operational view.
came in at a solid $1.51. That significantly beat consensus estimates of $0.35, 36 cents.
Right. So a beat of about 15 cents, that's pretty significant.
It is. Now, revenue landed at $1.586 billion, essentially in line with expectations of around $1.59 billion.
Okay, so revenue met expectations.
Met expectations, but it did represent an 8% year-over-year decline. So you've got this revenue dip, but a big earnings beat on an adjusted basis.
And that EPS beat wasn't the only headline, not by a long shot. On the profitability side, we saw GAAP operating income climb to $9 million. Now, that's a notable improvement from just $0.4 million in the prior year.
Huge jump.
Adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization. A key measure of operating profitability was $47 million compared to $57 million last year.
So down a bit there.
Down a bit there, yes.
Yeah.
But what really captured the market's attention, and quite frankly ours, was the adjusted free cash flow.
Ah, the cash flow.
For the quarter, it was $13 million. That's more than double the $5 million generated in the same period last year.
Wow, in Q2.
Exactly. This isn't just a good number. It's a significant achievement considering Q2 is typically a cash outflow quarter for many retailers, because of the inventory buildup for the crucial back-to-school season.
Right, getting ready for that push.
So consistently generating free cash flow like this, especially during a major overhaul, it signals remarkable operational discipline and a solid financial foundation. That's exactly what investors want to see from a company trying to redefine itself.
Yeah, that's really turning the tables, isn't it? 160% increase in free cash flow year to date, especially when Q2 is typically tough for cash. These numbers paint an interesting picture, but the real story, I guess, the engine driving this, is ODP's multi-year Optimize for Growth plan.
That's the core of it.
This isn't just some catchy phrase they've come up with. It's a strategic overhaul designed to dramatically reduce fixed costs, sharpen their B2B focus, and strategically expand into higher growth sectors like hospitality and healthcare.
Right.
In Q2 alone, they closed 23 retail stores, 3 distribution facilities, and 1 satellite location. Incurred $12 million in restructuring expenses just for the quarter. It's almost like ODP is shedding its old skin,
Yeah, like a caterpillar.
trying to become, well, hopefully, a very profitable butterfly in the B2B space.
That's a great analogy, actually, because what's truly fascinating here is the forward-looking aspect and just the sheer scale of this restructuring.
It's ambitious.
It really is. The company expects total planned costs between $185 million and $230 million over its lifespan. That's no small sum.
Not at all.
However, they're targeting approximately $380 million in EBITDA improvement and over $1.3 billion in total value creation over the life of the plan.
Okay, so big investment, big expected payoff.
Exactly. This isn't just optimism. It suggests a very strong conviction in the long-term benefits of these short-term but significant adjustments. They're clearly betting big on these strategic shifts to fundamentally alter their cost structure and their revenue profile.
And that B2B pivot you mentioned is already showing early, very promising signs of paying off,
Right.
particularly in hospitality.
That seems to be the key focus right now.
Yeah, ODP announced a major strategic partnership with one of the world's largest hotel management organizations, covering some 15,000 members. They've already successfully onboarded about 1,000 new hotel properties.
1,000 already, wow.
And reporting robust month-over-month growth. What's even more compelling, though, is that this expansion into hospitality isn't just about selling new product lines like, linens or cleaning supplies.
Right, it's broader.
It's actually driving increased demand for their traditional office products among these new hospitality customers. Initial data showing low double-digit growth in those categories.
That's fascinating. So the new vertical is pulling through demand for the core business, too.
Exactly. It really highlights their vision to become a total solution provider, meaning they're aiming to be the single source for all the operational supplies and services these hospitality and healthcare clients need.
From paper clips to who knows what else.
From traditional office supplies to cleaning products, maybe even facility maintenance solutions down the line.
Indeed, that ambition to become a total solution provider is, well, it's a core tenet of their new strategy. But it raises an important question. Can they effectively execute on this vision? Can they truly integrate into their clients' operations, going beyond just a vendor relationship for these new verticals?
That's the challenge, isn't it?
It is. Their supply chain business, VER, is playing a crucial role in supporting this. VER is seeing impressive 90% year-over-year revenue growth from third-party customers.
90%.
90. And a 32% increase in EBITDA from those external clients. So VER also acts as a strategic asset in managing inventory and navigating the evolving tariff environment.
Ah, yes, tariffs. Always a factor.
Management reiterated they're well-positioned to mitigate these challenges. About 57% of their inventory is either MAP priced or exempt.
Explain MA priced quickly.
MAP priced means minimum advertised price agreements. Gives them some pricing protection. And exempt means, well, they aren't subject to certain tariff increases. This kind of financial and logistical agility is critical as they expand into more complex B2B offerings.
That's a crucial detail. Okay, so despite the overall revenue decline for the corporation, the Office Depot retail segment, the stores you still see, is showing surprising resilience.
We haven't fallen off a cliff.
No, it actually delivered improving year-over-year trends, fueled by targeted sales initiatives and operational excellence. Management reported strong performance continuing through July and into the early back-to-school season.
Which gives them confidence, even with those broader industry forecasts predicting potential declines in that segment.
Right. It suggests their tactical execution, getting people in the door, higher average orders, loyalty programs.
Yeah.
It's delivering, even within a really challenging retail environment.
So even the part of the business they're ostensibly shrinking or moving away from is still finding ways to perform.
It seems like it.
Exactly. And on the balance sheet, the focus on cash generation is paramount and clearly paying off, as we mentioned. Their strong adjusted free cash flow of $13 million for Q2 contributed to an impressive $58 million generated year to date.
That's the 160% increase number again.
That's the one. A staggering 160% increase over the first half of last year. This robust cash position has allowed them to pay down approximately $35 million in debt.
Deleveraging, good to see.
Very good. Improved their financial flexibility significantly.
Yeah.
And for the full year, they've actually raised their adjusted free cash flow outlook to over $115 million.
Raised guidance, that's confidence.
It reflects heightened confidence in their inventory management, their cost structure optimization, and their overall business model. Of course, this all assumes a stable macroeconomic and tariff environment.
Naturally, the usual caveats.
But this consistent cash generation gives them the breathing room and the capital to fund their strategic pivot without taking on excessive risk.
Okay, so given everything we've discussed, the aggressive restructuring, the B2B pivot, that impressive cash flow generation, and the resilience in retail, how should you, as an investor, interpret these moves? The market's initial reaction, pushing the stock up 9.5% on the earnings day, clearly signals a positive reception to ODP's strategic execution and cash discipline, even with that top-line revenue decline we talked about.
Right. The market looked past the revenue number.
It suggests investors are looking beyond the immediate sales figures and genuinely buying into the optimize for growth story. They're seeing the forest for the trees, maybe, focusing on the future rather than just the past.
Absolutely. It really highlights a divergence in sentiment. While some street analysts, like UBS, maintained a neutral rating with a $19 price target.
Still seeing it as legacy retail, perhaps.
Perhaps, yes. Still viewing ODP through that lens. But the market's enthusiasm on the day indicates that the buy side, the big funds, they're actively rewarding progress on profitability, free cash flow generation, and critically, the pivot to higher growth B2B verticals like hospitality.
That pivot really seems key.
It has the potential to fundamentally re-rate the business, changing how the market values the company entirely. The company sees its key catalyst for the second half of the year as continued top-line momentum in ODP Business Solutions.
Keep that B2B growth going.
Delivering on that raised guidance, the greater than $115 million adjusted free cash flow, securing even more hospitality and healthcare contracts, and ongoing footprint optimization, closing more stores smartly.
So clear, measurable goals.
Exactly. Concrete goals that will dictate whether their story gains further traction.
And the management team, particularly the CEO, isn't holding back, are they?
Not at all. Very vocal.
He expressed strong conviction, calling the company tremendously undervalued at what he sees as a liquidation multiple.
Which is quite a statement.
It is. For our listeners, a liquidation multiple implies the market is valuing the company as if it's about to sell everything off, rather than as a growing business. He even stated he believes it's a strong buy.
Putting his own view out there strongly.
He emphasized the daily operational focus, the impressive momentum in hospitality, noting a recent day was their biggest ever in that segment, and their demonstrated ability to tackle various economic environments. This is a management team clearly focused on proving the value story and closing that perceived valuation gap.
Definitely sounds like it.
But what are the counterarguments? What concerns might investors still have given the revenue decline and the broader market for office supplies?
That's a crucial question, you're right. While management is bullish, the challenge is sustainability. Can ODP maintain the momentum needed to truly shift investor perception?
Yeah.
From struggling office supply retailer to diversified B2B solutions provider.
The narrative shift.
Exactly. The trailing total returns show ODP outperforming the S&P 500 and the retail ETF, XRT, over the last 1 and 3 months, which is positive.
Short-term outperformance.
But still significantly underperforming over the last year. Closing that 1-year gap will depend heavily on consistent, flawless execution against these second-half catalysts we just mentioned.
No room for error, really.
Any stumble in securing new contracts or maintaining free cash flow could slow that narrative shift. The skepticism will likely linger until they can prove their transformation is not just underway, but firmly established and generating consistent growth.
Makes sense. Okay, this is the part where we get a little audacious.
The fun part.
As always, this is not financial advice, just an idea. But if we were pitching an outrageous but plausible trade idea for ODP to an investment committee, here's what we might consider, building on everything we've just discussed.
Okay, let's hear it. Given management's firm belief that ODP is tremendously undervalued and a strong buy, combined with that immediate positive market reaction despite a, lower street price target, we could envision a long equity position in ODP with maybe a 6 to 9 month time horizon.
Yeah, long ODP. Why?
The core of this trade hinges on the market continuing to digest and reward their strategic transformation.
So the thesis is this. The market just hasn't fully priced in the ongoing significant pivot towards high-growth hospitality and those adjacent B2B verticals.
Still lagging behind the story.
Right. The company is actively shedding legacy costs, generating that significant free cash flow, which we saw as critical, and paying down debt. We'd suggest buying ODP stock around its current levels, perhaps setting a price target in the, say, 28-32 range.
Yeah, that seems plausible if the re-rating happens.
This target reflects that re-rating, viewing it as a diversified B2B services provider rather than just a legacy office supplies retailer. We believe the catalysts in H2 are strong enough to force this reevaluation.
And to make it potentially even more compelling, maybe manage risk a bit. You could pair this with a short position on a legacy office supply competitor.
A pair trade.
Exactly. Find one that has not articulated a clear, actionable strategy for a B2B pivot or shown similar robust free cash flow generation.
So you're betting on ODP's strategy working and a competitor lagging.
Precisely. This creates a market-neutral element to the trade, meaning it's less exposed to overall market swings, while still capturing the potential alpha, the outperformance from ODP's strategic shift.
Okay.
The expectation is that ODP's second-half catalyst will deliver, forcing the market to acknowledge its fundamental transformation and close that valuation gap the CEO so adamantly spoke about.
Interesting idea. All right, to wrap up our deep dive into the ODP Corporation's Q2, it's pretty clear they're in the midst of a significant high-stakes transformation.
No doubt about it.
The strategic execution of their Optimize for Growth plan, coupled with that strong cash generation and the aggressive push into new B2B verticals like hospitality, it painted a picture of a company working incredibly hard to earn its future growth.
It's not just a facelift, it's deep structural change they're attempting.
They've set clear, ambitious targets for second-half performance, particularly on free cash flow and continued momentum in their B2B segment.
And how they deliver on these milestones will be absolutely crucial in reshaping their narrative and ultimately their valuation. Remember, everyone, this discussion is for informational purposes only.
Definitely not financial advice.
Please, always do your own research.
We'd love to hear your thoughts on ODP's strategic pivot, though. Are you buying into the hospitality growth story? What catalysts are you watching most closely as they try to redefine themselves? Let us know.
Yeah, we're curious.
Thank you for tuning in to Talk Tickers, and we'll catch you on the next deep dive.